One of the key parameters in direct or mutual fund investing is having patience and a long-term approach. And historically, the Indian mutual fund industry has rewarded these long-term patient investors. Now, to understand the irony of this whole situation, let's take a look at the investor psyche itself. You see, to calculate the fund returns, we generally take a look at the NAV over a period of time. But that is not the correct way to approach mutual fund investing. In fact, most investors try to do that and try to catch the highs and lows of the mutual fund NAVs, which is practically almost impossible to do. In addition to the past performance, investors should also know about the fund manager's philosophy, the strategy that is used in the fund, and the style of investing. Well, even if you're invested for a long period of time, having conviction in your fund manager and your fund manager's philosophy is very critical to extracting the maximum returns through that fund. Now, this is not anything unique in India. Even globally, this is one of the key points that investors miss out on. Now, to understand the point better, let us compare the lump sum returns, SIP returns, and the demonstrated fund returns to understand the differences in the three. Now, as you can see on this chart given here, the lump sum returns from the mutual fund are actually lower than the demonstrated fund returns itself. However, if you would have gone through the SIP route of investing, you can see your potential of returns would be almost equal to the demonstrated fund returns. This is why the route of SIP investing is widely publicized as the most efficient method of investing. Now, this is actually because of the dual benefit that SIP gives you. The first one is the benefit of regular investing, and the second one is the benefit of cross-cyclical investing. The first benefit is very easy to understand. Basically, if you're a person who has a regular cash flow, like a salaried employee, you can automatically set a date where your SIPs will be carried out and you can do it regularly month after month, thereby investing in a very nice disciplined manner. To understand the second point, let's take a look at this chart here. This chart basically shows the gross sales of the Nifty 50 that have occurred. And if you observe, the trend of the Nifty sales are exactly like the returns from Nifty. What this basically means is that when Nifty is going up, people tend to buy more. And when Nifty itself slows down or consolidates, people actually redeem or sell their mutual fund units. And this is not a good thing. Now, in this situation, if you would have continued your SIP investments, well, you would have continued investing through all the market cycles, thereby giving you the second benefit. Now, this is one of the prime reasons why investors make lesser returns compared to the fund returns. Now, to basically avoid this problem, it's very simple. All you have to do is remain invested through the complete market cycle, and you can do it in a nice, systematic and disciplined manner. Now, let us take a look at the bad habits that you need to avoid while investing. The first habit you need to avoid is overreacting to the market cycles. Basically, don't react to the short-term noise happening around and don't be part of the greed and fear cycle in the market. The second bad habit to avoid is focusing too much on the short-term gains. Don't take a look at the short-term gains, rather take a look at the long-term investment story. That would be better to take a look at and it would give you a higher return. The third habit you need to avoid is taking knee-jerk decisions of investments. Basically, don't take an investment decision impulsively. Rather, take a disciplined approach and stay invested systematically through a long period of time. Now, let's take a look at some of the habits that investors must have in order to increase their overall returns. The first habit you must have is very simple but very effective. It's basically start early and invest regularly. Basically, if you start investing as soon as possible and remain invested regularly through a long period of time, you will get the full benefit of compounding. The second habit that investors must have is to ignore the short-term market noises. Basically, take a systematic investment plan and stick to it even when the markets are down or even when a market enters a phase of correction. The third and the most important habit to cultivate is to start investing only in long-term strategies and long-term funds. Basically, don't play into the short-term noises and the short-term trends that occur for a small period of time, but rather invest systematically for a long period of time to get the complete benefit of the fund returns. So, to conclude, you can clearly see that the SIP route of investing is much more beneficial and has the potential to generate higher returns. And remember, stick to the good habits and skip the bad habits to get the maximum benefit from your funds.